All right, we can get started now. Others will join as we go. And welcome to everyone to our webinar being hosted by the IAA Banking Virtual Forum. My name is Michael Tchareva, and I am the chairperson of the Banking Virtual Forum. I'm sure some of you or most of you would be familiar already with me because we have held these webinars a number of times. This particular webinar is on banking regulation changes affecting financial risk management and looking at the past and the future. Now, before we proceed, I would like to just give a disclaimer, as we normally do, in terms of views and the opinions expressed in this presentation and in the Q&A session, which are those of the authors and presenters and do not necessarily reflect the policies or positions of the IAA. Every effort would have been made to ensure the accuracy and completeness of the material, but the IAA and the authors give no warranty in that regard, and they reject any responsibility, as you can read the disclaimer yourself. That's a standard practice. Now, if you move to some housekeeping rules, questions and comments, you can type your questions in the icon at the bottom of your screen. They will be answered at the end. And if there is any question that can be answered during the session, it will be repeated at the end as well, because this is being recorded. So there are no verbal capabilities as they've been turned off. So you wait until the end of the session for questions to be answered. Then there will be a recording and the presentation, which will be put on YouTube, and it will be available on the IAA website after probably a day or so. So just watch out for that presentation and the recording itself. Now I'd like to move to introduce our speakers. Our speakers today we have got Stephen Scott and we have got Monique Duval. So I'm going to introduce the two speakers. Stephen is a partner at Deloitte, focusing on the assurance of a Prudential regulation client service offering as part of Deloitte's broader financial risk offering for the past 5 years. Stephen also provides advisory services linked to Basel reforms across Pillar 1, 2, and 3 that consider operations in the niche environment at the intersect of IFRS and the International Accounting Standard Board with his chartered accountant and registered auditor background. And prior to joining Deloitte, Stephen was responsible for overseeing development of a credit regulatory reporting solution for a Tier 1 bank in South Africa, and oversaw South African prudential reporting and elements of financial reporting across several African countries as part of his nearly 20 years of banking experience. So that's Stephen. Please help me welcome Stephen Scott. Then we have got Monique Duval. Monique is a partner at Deloitte, focusing on banking, treasury, capital, and risk management and liquidity management client service offering, as well as market risk and counterparty credit risk. She specializes in regulatory change in the trading and the treasury environment and supporting clients with the understanding and implementation of new regulatory requirements. Prior to joining Deloitte, Monique spent 10 years at another Tier 1 South African bank, focusing on similar topics across 13 African countries. Those are our speakers. Please help me welcome Monique Duval. So before I hand over to Monique, you will see that South Africa is referenced in this presentation, but we know that the audience is international. So we typically do that and we'll just take it as a case study, but you realize that in your own jurisdiction, there may be different issues, but international regulations like Basel are really the same, apart from the fact that each jurisdiction, adopts what it needs to adopt from the Basel, but the regulations are really almost the same. So this is relevant. This is international relevant, even though there's reference to South Africa as a case study. With this, I would like to hand over now to Stephen and Monique. And Stephen and Monique, welcome. I hand over to you now. Thank you.
Thank you very much for the introduction, Michael. Great to be here. Hello, everyone. Good. So, as Michael has mentioned, you'll see a lot of references to South Africa, but of course, the Basel regulations are meant to be international. So we'll zoom in and out from a country perspective as we go along. We'll cover, as you can see, quite a number of risk types. This is, of course, not the full universe. There are additional risk types that are affected by the Basel regulations and other changes that have also been introduced. But these are the key elements that we are sharing with you today, given that we only have an hour to do so. So you can see we are covering credit risk, operational risk, market risk, including CVA risk, and then interest rate risk in the banking book. And we'll end with a short bit on the output floor. Thank you. So firstly, in South Africa and worldwide, there have been a lot of regulatory changes of late. Some of these may sound familiar to you, some of these may already have been implemented, and some might still come, depending on where you are based. But very briefly, the key ones that's getting a lot of attention at the moment is firstly, of course, the Basel reforms themselves. So in South Africa, it is colloquially referred to as Basel IV, although that's not technically correct. I've also heard it being referred to as finalized Basel III or Basel 3.1. Assume those all mean the same thing for the sake of this presentation. Now, as we know, these reforms are on the back of the 2008 Great Financial Crisis, or GFC, and we'll be going through the details of that during the course of this presentation. Then, if you jump to number 2, resolution frameworks is also something that came off the back of the GFC. This is effectively the living will of the bank. So in other words, if you as a GSIB or DSIB were to fail, how are you going to make sure that you do it in an orderly manner and not take the whole financial market with you? So in short, that is what resolution frameworks are about. An enormous amount of work to get that in place, and different markets are at different stages of implementing it. In the UK, and I think it's been in place for quite some time. In South Africa, we are still in the process of implementing it piece by piece. Another element that's also at different stages of implementation worldwide is CODI or something similar, which is basically just depositor insurance. So this went live recently in South Africa, and again, in different countries, it will be at different stages of implementation. Then, of course, conduct standards. I think in South Africa, it's largely been focused on retail for obvious reasons. But in our larger markets, of course, wholesale conduct standards have gotten a lot of attention. Mis-selling and elements like that are getting a lot of regulatory attention, and banks have to implement a lot of remedial work on the back of that, in addition to very interesting things like trade surveillance and so forth. So that is another one really affecting, especially the global markets business in those countries where wholesale conduct standards have gone live already. Then, of course, there are various digital reforms. I'm not going to go into that in too much detail. I think that's a whole seminar by itself or a whole day by itself, but I'm sure in the various markets you're well aware of what is happening there. But of course, a key one, whether it relates to data privacy, AI, crypto, and so forth. Another one that I'm sure everyone is familiar with is ESG, so I'm not going to spend too much time on that. We know that that has gotten various levels of attention, and under the current administration in the US, the amount of attention may vary depending on where you are, but a very interesting one nonetheless, and very topical still to this day. Benchmark reforms. So I think in the rest of the world that this is largely landed. So these are, for example, your LIBOR transitions and so on. So most of the market, most of the developed markets have already gone through these transitions. In South Africa, we are still in the process of that. Umoja, I won't elaborate on too much. It's about regulatory reporting, but quite South Africa specific. And then, of course, AML and counterterrorism financing is, of course, also quite relevant. I don't think that will change anytime soon. Great news from a South Africa perspective is that we were just taken off the grey list earlier this week. So that is a very exciting development for us and a great relief. So a lot going on from a regulatory perspective. And the intention of this page is just to give you the sort of some of the bigger picture. Of course, there's a lot more than this that is happening worldwide, but just to place into context that Basel III or Basel IV is not the only thing that banks have to deal with. Regulatory fatigue is a very real issue, and of course, regulatory divergence across different markets is another very practical and yet disruptive element that banks with multinational operations have to deal with. So thank you. We can go to the next page. Coming back to Basel, so I won't go through all of the detail. You can scan through the tables or the picture at the bottom. I think the key message here is that Basel started with the basics back in the day. I'm sure there are many participants on this call who weren't even born then, but systematically expanded, as you can see there, if you look at the lighter gray cells, to cover more and more risk types as the market necessitated more regulation around those risk types. So as you can see with the latest one, so let's call it Basel 3.1 as it is done on this slide, it affects really almost everything. Basel 3 and Basel 3.1, I like to sort of explain it as it's as if the old rule books have all been thrown away, especially in terms of some of the methodologies that we'll get to in just a moment for the different risk types. And really, the committee went back to the drawing board to look at the methodologies and see, do they actually still make sense? And what do we need to do in terms of making sure that that remains the case? Right. Thank you. Yeah, thank you. So in terms of Basel III, what is the key? Why is this so exciting? What is the point of this, other than introducing something that is even more complicated and even more onerous to implement? So, as I mentioned, this followed from the financial crisis, during which the regulators and banks all realized that the current approaches, especially for banks, and that this is usually the larger ones, under internal models, were miscalibrated and had a lot of wiggle room, if we can put it like that. So they realized that it is necessary to implement something that is a lot more strict, something that gives them the ability to compare banks on a like-for-like basis, and of course, something that is a lot more robust. So the internal model approaches, as I mentioned, was one of the key issues, because that allows a lot of leeway for banks to interpret regulations and implement them in a way that they see fit. Initially, a good principle to begin with, because the idea is that banks would understand their own risk in the best way. But of course, unfortunately, we know how that played out. Thank you. Next page, please. If we can have the next page, please. Thank you. Great. So the key changes on the Basel III framework are the following, and we'll go into them in a bit more detail. But if you wanted sort of just a summary of the 6 key elements, then this is what it is. So firstly, enhancing the capital buffer. We're going to look at that. So the good old 8% flat that was introduced in Basel I has evolved quite substantially over the last couple of years. Then constraining excessive leverage. So the leverage ratio was introduced to do exactly that. In most markets, from a liquidity perspective, metrics like LCR and NSFR have already gone live. So for those who are not familiar, that is with the liquidity coverage ratio and the net stable funding ratio. So that is to strengthen your liquidity profile, especially under stressed conditions. Then in terms of the standardized approaches, so the standardized approaches typically didn't get much attention during the change from Basel 1 to 2 to 2.5. So they were outdated and not exactly risk sensitive, far from it, in fact. So the standardized approach for credit risk, market risk, or trading risk, as well as operational risk, have all been revised. And what's also important is that all banks have to implement the standardized approaches, even if they do have the capability to implement the internal approaches as well. The reason for that is if the regulator deems your internal approaches to be inadequate in any way, they can force you to use the standardized approach for capitalization purposes. So they needed to make sure that that backup approach is solid and robust. Okay. And then lastly, to reduce excessive risk-weighted assets variability. So this is where the output floor comes into the picture, which we'll go into a little bit later. Effectively, the output floor reduces the amount of benefit or capital savings that a bank gets from implementing internal approaches instead of standardized approaches. So as I mentioned, the capital supply side as well as the capital demand side have been affected. From a capital supply side, the definition or the requirements in terms of how much capital banks have to hold has increased rather substantially. So as you can see from the picture, under Basel III, a few extra elements were added, namely the capital conservation buffer. And this is the one to make sure that the banks do not jeopardize their financial strength by making payments like dividends and bonuses that take them into financial difficulty. So once you need to rely on that buffer, restrictions on distributions become effective. Then there is the counter-cyclical buffer, which is designed to manage the capital profile or capital levels during economic cycles. And lastly, there is a GSIB or DSIB buffer. So if you are a bank of such importance in the local or international market, there are additional capital requirements that apply. So this is being phased in various markets, depending on where you are. And most, I believe, we are already all the way to the top, but there might be some that are still in the process of implementing. Thank you. Next page, please. Thanks. As I mentioned, the changes in the Basel framework are quite substantial. It affects all of the pillars of the Basel framework. For those who are not familiar, the pillars of the Basel framework are firstly RWAs. So this is in terms of your mandatory capital requirements or risk-weighted assets. So for certain risk types, regulatory capital requirements apply. The second pillar relates to the supervisory review and evaluation process. So some extra risk types are being caught in that net. And then pillar 3 is about public disclosures. So most banks, or again, depending on the jurisdictions, are required to publish a pillar 3 report in which they provide a lot more information around the exact state of their risk profiles. Back to Basel III changes, so that affected all 3 pillars. So as you can see under pillar 1, all of your key risk types have been affected. So that includes the introduction of the capital floors. Under pillar 2, the degree of freedom for measuring the risks has substantially reduced, and also a standardized approach for measuring economic value of equity for interest rate risk in the banking book was introduced. And lastly, under Pillar 3, further requirements have been implemented in terms of what is required in terms of banks' public disclosures. Okay. So in short, as you can see there on the bottom, it's quite an invasive piece of regulation. It's quite extensive in terms of the impact. So there's a lot in terms of the internal approaches. The rules and controls are a lot stricter. As I mentioned, we need to implement the standardized approach as a compulsory requirement. And what is very interesting is the new approaches penalize you in terms of capital for poor models and data. So for those who are close to banking, you might have heard the acronym BCBS 239, or which relates to risk data quality and risk and data finance alignment. So the intention of BCBS 239 was to, of course, introduce rules to make sure that the flow of data and the accuracy of data is accurate, is as expected. And all banks, most banks, state that they have implemented that and meet all requirements. However, it got to a point where now, as part of Basel III, it's almost as if international regulators are saying, well, we don't really believe you. So what we are introducing is penalties, although it's very, very, it's not direct penalties, but rather the limitations on the approaches. If you have poor data or missing data, then typically higher risk weights tend to apply in some shape or form. So the carrot is gone and the stick is definitely here. Thank you. Next page, please. Okay. What you see here is an overview of the South African implementation timelines. Of course, in every country, it does look different. Some are way ahead, some are way behind. The South African regulator, because of course we are not part of the developed markets, but rather a developing market, similar to Saudi Arabia, tend to stick to almost the original, give or take 3 years, almost the original Basel timelines, to maintain a regulatory equivalent status, which is quite important for our regulators and our markets. There are also other markets that have gone live. I've mentioned Saudi Arabia as another example. But most countries, as I'm sure you all know, especially in Europe, UK, and the US, have a much more extended timeline for the implementation of Basel IV. So as you can see, in South Africa, we have gone live with everything, the last bit having been the market risk or fundamental review of the trading book element, which went live just a few months ago. And our banks are currently reporting on this basis, and we are supporting them in making sure that all the last niggles are being sorted out. Thank you. I am now going to hand over to Stephen, who's going to go into a bit more detail on the credit risk changes, and then I will be back a little bit later to speak to market risk elements. Thank you, Stephen.
Great. Thank you, Monique, and good day, everyone. If we move on to the next slide with content, please. Under the credit risk framework, the Basel Committee realized that there were a lot of shortcomings that existed in relation to how credit risk was being calculated, specifically when it came to modeled approaches throughout Europe and internationally. One of the case studies that was investigated, and Basel published a paper on it, was the risk weight variability experienced between banks with a standard set of data that Basel had prepared, Basel had prepared and shared amongst those banks for consideration and to obviously. And the risk weight variability was quite dramatic between an average kind of risk weight of, let's say, 30% up to 300% across a wide range of banks. And to address these shortcomings, particularly risk weight variability, the committee looked at ways to reduce the complexity relating to specifically the IRB approaches, but to also then try ensure that there's a bit more comparability around how banks are modeling and therefore how capital requirements are ultimately determined for similar risk events that banks are facing across similar jurisdictions or even different jurisdictions. In this regard, there were quite a few changes made, and we'll touch on some of those on the later slide. But effectively, at a high level, the ability for advanced internal ratings-based approach modeling, which is what the A-IRB stands for, and apologies, IRB for those who are not necessarily in the banking space, stands for internal ratings-based. The advanced internal ratings-based approach was removed for several asset categories. The variability relating to some of the factors that are key in driving the risk weight equation was reduced by implementing either floors or caps to ensure that there's a level to which risk is uniform across all jurisdictions and banks using the internal ratings-based approaches, and that affected the probability of default, or PD, metrics, the exposure at default, so how to calculate what the value of default is when it occurs to a customer, as well as the LGD, or loss given default, to ensure some comparability and conservatism that came into those calculations. There was also greater specification of parameter estimation that resulted in more comparable risk weighting across these entities. So overall, some of the risk weights the banks faced increased given some of these changes, although market participants, the impact was varied depending on jurisdiction, as well as how robust and maybe optimistic or pessimistic some of their modeling attributes were, as well as their internal loss history. But on overall basis, risk weight variability increased, risk weightings increased due to the changes and reductions in variability that were implied as part of the Basel regime. One of the benefits, though, that came out of the new approach being finalized was the removal of the scaling factor that IRB-based banks had to apply. A scaling factor of effectively 6% on top of the calculated risk weight was a mandatory requirement in South Africa and in many jurisdictions internationally. This, however, has been removed in light of the standardization and the reduced risk weight variability coming into play. If we move on to the next slide, this slide, once we get there, thank you. It gives a high-level overview of what are some of the key changes and what are some of the asset classes that were affected. For those who are not familiar with asset classes, it's the Basel way of, I suppose, segmenting exposures to certain counterparties into meaningful classifications that ultimately are used as the first decision point in a risk weighting. And many of the large asset classes where you've got perhaps two large corporate entities or to banks or other financial institutions, information and I suppose data points around specifically loss given defaults as well as exposure defaults were not necessarily well known and well provided and were quite thin in the market. This resulted in the change from many of these exposures being able to be risk weighted under different approaches under Basel II. So these could be under the advanced IRB or the foundation IRB or the standardized approach. This resulted in the move to the risk weights only being determined on these exposures under the foundation IRB, which is a simpler approach and with more rigid parameterization based on Basel's prescribed LGDs and EADs, as opposed to the bank being able to internally determine each of the PD, LGD, and EAD in determination of the risk weightings themselves. So overall, can see along with a reduction in risk weight variability, there was also a reduction in the availability of options to risk weight specific asset classes in light of the thin data points that existed, or the few data points that existed in the market and in practice for banks to use and to model accordingly. We move on to the next slide, please. And the next one, please. Now, not only did the internal ratings-based approach change, the other approach that banks could follow, being the standardized approach, or CRSA, credit risk standardized approach, also had some substantial changes. In addition to the shortcomings identified as part of the Basel Committee's assessment on the IRB approaches, Basel recognized that the standardized approaches, which are generally meant to be simpler types of calculations, were not risk sensitive enough, and there was too much divergence from particularly some of the asset classes that existed in the IRB approaches, which resulted in complexity and confusion and lack of comparability with depending on the reporting bank. So the Basel Committee required several changes to be made. The key things that were made were the reduction on dependency of external ratings. As part of the financial crisis in 2008, if we think back, many can recall that many of the US-based mortgage entities or mortgage vehicles were AAA rated, and we know how that turned out in the end. And so the use purely of external ratings was found not to be complementary and necessarily risk appropriate for many of the banks. Therefore, the Basel Committee mandated that an internal due diligence needed to be performed in addition to taking the external ratings that may exist. The internal due diligence is meant to be an overlay that if you as a bank are identifying potential problems with a customer for whatever reason, that your risk weighting is appropriately adjusted to be the higher of either the external rating-based risk weighting, determined via various methodology, I suppose, a table-based approach, the intersect of a row and line in the table, and the due diligence itself. So what risk weighting would you apply had you not had an external credit rating? There was also in the differentiation of risk weighting itself, it was noted that the loan to values used across both commercial mortgages and residential mortgages were creating risk insensitivity, and consequently sensitivity needs to be built in, which resulted in a lot more risk weightings being applied to real estate financing, as well as the introduction of several different types of real estate asset classes in the standardized approach. Further to that, the calibration of risk weights and credit conversion factors needed to be changed. The calibration of credit conversion factors, so that was in relation to off-balance sheet exposures, very non-sensitive. There were only 2 or 3 different categorizations, which resulted in a 0, 20%, 50%, or 100% credit conversion factor being applied. That has changed markedly, with much more guidance provided in determining the risk weight factors and credit conversion factors that needed to be applied. This has also resulted in the imposition of a 10% minimum credit conversion factor floor on all off-balance sheet exposures as part of the revisions to the framework. The other aspect in terms of the asset classes and exposure classes, very much aligned with the differentiation in mortgage and real estate financing, resulted in consideration of both the collateral that is used in real estate financing and the type of borrower that is being lent to. So a matrix type approach being applied in determination of the asset categorization, as well as then the ensuing risk weighting that has to be applied. Now, key in the credit risk standardized approach, and Monique will touch on this a bit later, is that although a bank might have been applying the internal ratings-based approach as its sole calculation of risk weights and determination of capital adequacy ratio prospectively, this has now changed in that any bank that has an IRB portfolio has to also calculate that IRB portfolio on the credit risk standardized approach. And the calculation of that portfolio on the credit risk standardized approach forms a key input into the output floor, as we'll see a bit later. Impacts that one need to consider. If we move on to the next slide. In terms of banks, they need to consider whether the real estate, the pricing that they're following, the risk weighting impacts that are now being affected. If we can just please move on to the next slide, apologies. Banks need to consider what their existing book looks like and how they're going to reprice for some of these changes that are coming through because of the changes in risk weightings on particularly their property portfolios. Thank you. This entails assessment of the product design, assessment of how do you change a legacy book, often which has been in place for maybe 10 to 15, 20 years, depending on your market. In South Africa, we see the average repayment period is about 8 to 10 years of a mortgage bond originated. It varies in different jurisdictions. But now with the risk weighting implications, how do you consider some of your product designs on that? In terms of banking and how you deal with some of those banks, one needs to carefully consider your correspondent banks that you engage with, the risk weights that you apply there, and perhaps a much more managed approach to the float that is placed with correspondent banks. But also one needs to consider whether, if your bank is unrated, the bank that you might be working for or engaging with, if they're unrated, how their funding may be impacted, as a lot of banks are often funded perhaps overnight or over with short-term or longer-term funding from other banking entities. The requirements under the standardized approach to credit risk now require an assessment of grading of a bank, which can have a marked impact on the risk weighting that has to be applied. Consequently, financing strategies need to be specifically considered. There are also specific considerations given the change in asset classes on corporates that need to be considered, specifically with specialized lending. And then within a retail space, there were limited impacts, although lending criteria and the pricing in relation to foreign currency denominated loans that are being repaid in a different or in a currency different to that originated in need additional focus. So that may affect several markets, particularly where multi-currency type of lending is in place and it is paid in currency as opposed to foreign currency. Thank you. I'm going to hand back to Monique to cover the market risk sections. or sorry, apologies, I've got one more slide. We just move on to operational risk. The other big change in relation to the Basel requirements came through operational risk, whereas previously there were several approaches that could be followed. The AMA, which is the advanced measurement approach, back one slide please, the basic indicator and standardized approach. However, now there is a single approach that all banks need to follow, where the determination of a business indicator component is considered, determined via various metrics that come through a bank's income statement, and that is then multiplied with the internal loss multiplier, which is based on historical operational losses of the previous 10 years. The benefit of this approach is that it is far more aligned with a bank's operational maturity, i.e., if you are successful in mitigating and have good controls and processes in place to limit the impact of operational losses, then you get a benefit through the internal loss multiplier, as opposed to perhaps another bank which could have the same business indicator component calculated in or a similar level or value of business indicator component, but has much worse internal controls, resulting in higher losses. Overall, we did see that banks' operational losses or the risk weights associated with operational losses increased as a result of this change. However, many banks have, I suppose, consequently looked to tighten up on the internal controls and processes to mitigate some of those impacts. Thank you, Monique. I will now actually hand over to you for the FRTB.
Thank you, Stephen. Great. If we can move on, please. I'm also going to go through the slides fairly quickly and skip one or two so that we still have enough time for questions. But as Michael mentioned at the beginning, the slides will be made available to everyone afterwards. So if I'm going a bit fast or skipping over things, please don't worry. Let's talk about fundamental review of the trading book. So this is the element that looks after traded market risk and everything that sits around it. So firstly, the change to the standardized approach is that it has been made a lot more risk sensitive. So across the different asset classes, it was also very disjointed and it sort of didn't link into each other very nicely. Currently, or the new approach rather, applies a sort of variance covariance type of VAR approach or VAR estimate, if you will, to calculate the standardized approach, which is very, very interesting. Of course, the risk weights, which kind of play the role of a standard deviation, as well as the correlations, are prescribed by the regulations themselves. In addition, a lot more restrictions have been implemented around the internal model approach, which is the name IMA that applies in the case of market risk. So I'll mention a few of those on the next page, but in the interest of time, I'll move on for now. Now, as I mentioned, we do have the capital floor and the implementation of standardized approach that is mandatory for all banks. That, of course, applies to market risk as well. What is also very interesting is in order to qualify for the internal model approach, a couple of additional things have been added. So firstly, desk level approvals are required. Usually as a bank, you got the approval for the whole of the bank and off you go, you can apply internal model approach for everything. Now, of course, desks with more exotic or complex products or less liquid products struggle to get that desk level approval. This approval is based on two things, namely enhanced backtesting as well as P&L distribution. So backtesting, I think most people will be familiar with. It's basically to assess the quality of your value at risk model, or in this case, under the new IMA, we are using expected shortfall instead of value at risk. And secondly, P&L attribution is a little bit misleading, I think, as a name, but if effectively it tests whether the risk and finance, or rather the front office risk and finance data line up properly, and whether your risk model gives you a good approximation of the potential losses compared to the real what happens in the real world. Then the concept of non-modelable risk factors have been introduced. Effectively, again, also a slightly misleading term, non-modelable, but effectively what it refers to is less liquid instruments or benchmarks, if you will. Lastly, internal risk transfers and regulatory boundary are all about reducing the opportunity to take advantage of moving elements or moving trades between the banking and the trading book. So there are arbitrage, there's the word I was looking for, to arbitrage the regulatory boundary. So there are now much stricter rules in place that police the regulatory boundary going forward. Thanks. I think in the interest of time, we can just very briefly touch on the next slide. I'll just highlight a couple of things and we'll move on. Just to give you some examples of what the changes were in internal model and standardized approach. Next page, please. Thank you. So as I mentioned, the value at risk model was replaced with expected shortfall for internal model approaches. The double counting that used to exist between value at risk plus stress bar has now been replaced with expected shortfall calibrated to a stress period. What's also very interesting is that asset class specific holding periods have been introduced. And the rest of the slide, I think, explains what I was referring to earlier. I think the only thing that I'll also mention, because it's interesting from a methodology perspective, is the 3 elements of the standardized approach. So if you look in the yellow block on the right-hand side at the top, our standardized approach now consists of 3 capital requirements, namely delta, vega, and curvature. So as you can see, trying to incorporate non-linearity into the capital calculation. Thanks. Let's move on to the next one. Next page, please. Thank you. One more, please. Thank you. Credit valuation adjustments risk, or CVA risk. So for those who aren't familiar with CVA, that is the adjustment to the market value of a derivative contract to account for the risk that your counterparty might default before the maturity. So it's similar to loans, but this is the derivative version of it in a way. Now, it's a little bit complicated because there is counterparty credit risk that plays a role here, as well as the CVA element. The important thing to understand here is that because we are working with derivatives and we are working with things that are marked to market, it is a bit more complicated than your typical loan to calculate what the risk is, because not only does it depend on the quality of your counterparty, but also it depends on market value changes, because of course this is derivatives we are talking about. So as things constantly change in terms of market prices and interest rates and FX rates and so forth, the value of your exposure constantly changes, which is different from normal credit risk. So that's just something to keep in mind when it comes to CVA risk and counterparty credit risk when it comes to the trading book specifically. Thank you. Next page, please. If we can skip this one and go to the last one, just to highlight or just to focus on some of the key changes. Sorry, just in the interest of time, I'm skipping some slides. So if we can go 2 forward, please. Thank you. Perfect. Perfect. This is it. So just to confuse things a bit more, instead of having an internal approach and a standardized approach, they call it basic approach and standard approach. Of course, the standard approach is now the one for which you require specific regulatory approval. But in short, what it boils down to is that the basic approach would be suitable for banks that, if you look at the hierarchy there, don't actively manage CVA risk. So it's a basic bank, it's a small bank, they don't actively manage CVA, and they don't necessarily have the capabilities to calculate CVA sensitivities and the like. So in that case, you would go with a basic approach, which, if you look at the bottom right-hand side, only recognizes counterparty credit risk hedges that meet certain criteria. However, if you do have the said capabilities, you may apply to use the standardized approach, in which case you can also recognize market risk hedges. So again, as you can see, it all depends on the level of sophistication of the bank itself. Thank you. We can move on to the next topic, please. And we're going to skip a few slides so you can keep going until page 31, please. That's the interesting one around methodology, and that's typically what we enjoy. There's, of course, a lot of governance changes. Those are all summarized here for those who are interested. Effectively, what has happened is that in the past, everybody used to apply a 200 basis point shock when measuring interest rate risk in the banking book, because the Basel Committee calculated it many, many years ago as being representative of a 99th percentile shock on an annual basis for developed markets. And what happened was that the rest of the world, whether it's a developing market, a frontier market, or anything else, everybody else used 200 basis points as well, which is not necessarily representative of the situation in their market. So South Africa was one of the markets that was hit by much, much larger interest rate shock scenarios that have to be used for interest rate risk in the banking book going forward. To give you an idea, our shock moved from 200 basis points to 400 basis points, and that's the case for many other countries as well. In addition, if you look at the graph at the bottom there, a set of nonlinear scenarios were also introduced. And if you're familiar with interest rate risk in the banking book, you will know that this will highlight to you where you have mismatches in the short versus long term, which is more often than not the case for most banks. In addition, the banks have been required to implement behavioral models. So Stephen was referring to it earlier. You might have a contractual maturity of 30 years on a bond or 7 or 5 years on a vehicle loan, but we know that these are typically paid off much sooner. So the requirement is to incorporate that into your modeling. Similarly, we know that our check accounts, savings accounts, and so forth, whether it's retail clients or corporate clients, theoretically and on paper, we can all go and withdraw all of our money tomorrow. However, in fact, this form of funding to the bank on a behavioral basis turns out to be much more stable. So typically, banks recognize the stability of this funding in their models by lengthening the maturity up to 3, 4, or 5 years, depending on how stable they see it. As I mentioned, prescribed methodology for the economic value of equity has been included. So again, the regulators now have a basis to compare apples and apples. And then lastly, there is, sorry, if you can just go back one, there is a test in terms of interest rate risk in the banking book, whereby you have to check whether you are an outlier bank. Sorry, if we can just go back to the previous slide, please. Where you have to measure your EVE sensitivity compared to your Tier 1 capital base or a capital base. That, of course, places banks at risk now because, number one, there is a larger stress scenario. Number two, and the definition of the capital that you may use when calculating the risk versus capital ratio is much more tightly defined. So banks might much more easily become outlier banks, in which case you can be required to hold more capital or reduce your risk profile. Okay, thank you. We can move on to the last slide, please. Or the last two slides, rather. Thank you. Okay, so we were talking about the output floor quite a bit earlier. So effectively what it boils down to is that, remember I said that all banks have to calculate the standardized approaches, regardless of whether or not they have the capability to implement the more complex internal models. So the standardized approach, as I mentioned, is the fallback approach if the central bank or your regulator deems your internal models to be inferior, then they force you to adopt standardized approach. But where it's also used is in this concept of an output floor, which basically means that the benefits or capital savings, rather, that a bank can obtain from implementing internal models is capped. Okay, and that cap is 72.5% of whatever the standardized approach capital requirement is. So effectively, if you look at the green bars on the internal model side, if your risk-weighted assets are, let's say, 60, it means that you've got to, and your 72.5, you can see there, you have to effectively top up your capital regardless of what your internal model says. If we go to the next page, please. Okay, so on the left-hand side, we've summarized what the approaches are that are classified as standardized versus internal, given that the naming can be quite confusing. And the last point that I want to make on the output floors is on the right-hand side, which is that it is phased in over 5 years. So on the previous page, we showed that that cap is ultimately 72.5%. However, that's, of course, quite a big number to jump to right away. So it will be phased in most markets over a 5-year period or 6-year period, starting at 50%, increasing each year. Apologies if that was quite fast. We are at the top of the hour. I don't see any questions, so I am going to hand over back to Michael.
All right, thank you very much. Thank you very much, Monique and Stephen. I think there is one question. There was one question I saw. It was answered by Stephen, but I'm going to read it out. I think it was Abraham Hernandez. He said about the new securitization framework, the 2008 banking crisis had something to do with the securitization process, which led to nobody knowing which institutions ultimately held which specific risks. How has the new framework addressed this issue? And then Stephen answered, and he said, hi, Abraham, yes, the new frameworks implemented in 2010, much more punitive risk weights and requirements for more governance and risk understanding has been put in place addressing this issue. The latest changes of around 2022 affect risk weight calculation methodologies, but still require proper governance and risk understanding process. The 2010 framework resulted in a reduction of market interest in securitization, although the new Basel spoke about today on other assets may result in renewed interest in those vehicles to reduce risk weight impacts of the new regulations or affecting the funding strategies of banks. So that was the response, and that's the only question we got. So thank you very much. Since we are right on the time we are supposed to end this, we are not going to ask for more questions, but you can always email your questions to the IAA office, to Amali and Mit, and I'm sure they can be answered by Monique outside the session. It looks like there's yeah, okay, it's just a thank you. And with this, I would like to thank all the attendees, and Monique and Stephen, I would like to thank you. Most of the attendees have attended the webinar in the past, and what you have done here with the bringing the regulatory changes and the implications is bringing everything together, because we have done presentations on operational risk, on fundamental review of the trading book, interest rate risk, in the banking book, credit risk. We have done a whole lot of presentations where things were a bit more technical. Now, what you have brought here is to bring everything together, explaining those developments and their implications on banks, and I think that brings everything together. So thank you very much. We look forward to be holding these webinars, and hopefully, Monique and Stephen, hopefully we will bring you back on something else in the future, so that we can continue presenting these issues and providing and sharing knowledge with our audience. And to you attendees, thank you very much. Please continue attending these. There is a lot to gain by attending these sessions. With that, I would like to thank Amali and Mit for arranging this, giving us a platform as the Banking Virtual Forum. So thank you very much for making all these arrangements. Otherwise, with that, thank you. We will see you next time, all of you. Thank